free cash flow, though, is taken into consideration cash payments that are made, or maybe even cash receipts that are received that might be outside of what we're showing on the P&L. And we have to take those into consideration. Now, you mentioned capital expenditures, but there are other things that need to be taken into consideration for free cash flow, correct? I mean, I'm thinking maybe significant debt payments, or if a company receives their business model is they get money up front, but it doesn't necessarily get recognized as income over the course of the year because it might be advanced payments over a few years projects, or even estimated tax payments don't necessarily figure into.
Okay, so those are good. Those are good points. So let's cover the one about someone making a deposit or
Sure.
deferred revenue. It's a balance sheet item, not an income statement item. So
Right.
It doesn't show up in EBITDA.
Right.
If I pay you $100,000 for a project that's going to start as a deposit for something starting in 3 months, you're going to put it on your balance sheet as cash in and a current liability of deferred revenue.
Correct.
So that doesn't play into EBITDA.
Right.
In my world, this is calculated on a pre-tax basis. You get into larger companies, they will factor in taxes more often. But with the small business, and especially with pass-through entities like S corps or LLCs,
Sure.
There's a lot of ways for an owner to minimize taxes and not have, and unless they're C corp, they're not going to have corporate taxes.
Okay. So even if you have like estimated taxes, even on the business, I mean, I realize if it's a pass through, there's still, taxes that are related to the income of the business, and there's estimates that need to be made during the course of the year. And a lot of times those estimates are made as distributions to the owner,
Yep.
who then makes them personally, but they're still coming out of cash, of the business. So you wouldn't figure that into free cash flow?
Well, when we do free cash flow, it's designed to go into the valuation and any what is called a debt coverage ratio.
Right.
So every bank will be looking at what is the debt coverage ratio. So that means if it's 2-to-1, that means you have $2 of profit for every dollar of principal and interest payments.
Right.
And yes, there are your principal payments on debt are not tax deductible. They're they're an after-tax amount. Right. But at the corresponding level, going back to before I was in this business, the Tax Act of 1993, you can amortize goodwill over 15 years. Mm-hmm. So it can get complicated when you start going, what is actually taxable?
Right. That's exactly
that is a paper write-off and nothing else.